It's my pleasure to introduce Arne Staal, who is the Group Head of Benchmarks and Indices for LSEG. He's CEO of also FTSE Russell. He previously was a global head for research and product management for information services. Now, you have a quite diverse background here, being educated in the Netherlands and having a PhD from the Kellogg School. So Arne, can you kind of tell us a bit more about your background and about your current role at LSEG?
Yes, of course, Rohan. First of all, thank you very much for having me. It's really a pleasure to be able to engage with you like this. So in terms of my background, yes, I have a PhD. I studied at Kellogg, did a PhD in something very quantitative, so quite far away from what I do today. And when I first joined the workforce, I was convinced to join Wall Street. I joined Lehman Brothers, spent years on the sell side, then spent years on the buy side as well. And from that, I've taken very complete views away on how markets operate, both in terms of how capital markets function and how sell-side institutions provide the facilities and the pipelines and the tools for financial markets to work. And now from a portfolio management perspective, making investment decisions. So when I was asked to join the London Stock Exchange Group, first in the head of product and research role, and then later as the CEO of FTSE Russell, I was really delighted to be able to do that, because it's a place where all of those parts, the entire financial market, comes together. It's a cornerstone of the infrastructure of the major trends that are happening in financial markets and the way different stakeholders engage in financial markets. So that might sound a bit abstract. So let me give you the example of what I do currently. I'm the head of indices. I run FTSE Russell, one of the largest index providers in the world. And indices, as you will all know, but for the broader audience, are basically portfolios that represent investment opportunities and systematically track the performance of an investment universe in portfolio form. So they are really anchoring points for how different investment returns for different asset classes, different strategies develop over time. And indices have evolved from being benchmarks, data tools, something to look at when you make your investment decisions, do your capital raising, etc., to being central to investing itself, and that they're now the investment strategies underlying a lot of passive investing, ETFs, etc. And that, I think, is an interesting way of highlighting how data analytics, infrastructure, etc., is all coming together in new ways in financial markets, and I'm very excited to be part of that.
Fantastic. Now, London Stock Exchange, you guys have been really busy over the past several years with acquisitions and a lot of things going on, and more recently, the acquisition or the transaction with Refinitiv. What was the thought behind that, and how's that worked out?
Yeah, that's. I'll start with the rationale, and then I'll touch upon how has it worked out. It's working out is the short answer. We're not quite there yet. It's a big transaction. These things take time. But to start with the rationale, I'll give you the vision, and it's related to what I just said in terms of being a cornerstone of financial markets, touching capital raising, capital formation, how exchanges work. Data analytics tools, the information that markets needs to make decisions and to value things and to really play that capital allocation role, to the processing of trades, etc. That needs to happen in markets, all the accounting, all the bookkeeping that needs to happen. Because the London Stock Exchange Group covers all of those aspects, and it covers that full trade cycle in financial markets. Through the Refinitiv transaction. So Refinitiv is a powerhouse in terms of data across asset classes, across markets, across different themes, sustainable investing, carbon markets, private equity, infrastructure, etc. And it has the tools to interpret that data and deliver it to end users, portfolio managers, traders, risk managers, CEOs, CIOs, etc. Everyone in the financial system. And we didn't have that as London Stock Exchange Group. We didn't have that full scope of data and the mechanisms for delivering it with the information, decision-making, workflow, tooling around it. So that was the rationale that now as a combined group, we are that full service provider, financial infrastructure cornerstone of the market. Now, you asked how that's going, and I've been closely involved in the transaction, and that before the transaction, you will know very well how these things work, but there's a long lead time before a transaction like this closes. It's a large transaction. There's a lot of planning that happens, and I was very involved in the planning, especially on the question of how 1 + 1 is 3. So what are the synergies that you're going to gain from this transaction? So I was with a lot of colleagues looking for the +1, and the 1 + 1 is 3. And through that, we've put very detailed plans in place. And when you first enter into a transaction like that, you start executing, and you measure your success by how well are we executing on our plans. But what is at least as fascinating is that once you start doing that, reality is always a bit different than what you thought it'd be. Markets change, information changes, opportunities change, challenges arise, and you start adapting. And I think that we're not there yet, but what we are finding is that 1 + 1 is 4, and that there is so much more that we could be doing by connecting all those pieces in the infrastructure that we have now. So it's going well, but I do want to stress that that large transaction aspect, that there's enormous amounts of work involved and planning involved, and it's a journey. It's not a deal closed, new company, let's move on.
Right. Yeah, it's great. It's good to know. I guess it's better for 1 + 1 to be equal to 4 than moving the other direction. So that's actually great news. So, and given your background, you're like you identified yourself as a quant guy, right? And how you want to think about things. So with that, and in terms of the strategy to plan forward, so how are you guys using data analytics and machine learning, given the growth and everyone thinking about the important role that it may play going forward? So how are you guys working through those things?
Yeah, that's a great question, and it's an existential question for us, and I think for markets more generally, because whatever label you put on it, machine learning, AI, data science, data analytics, these are all facets of how computing power and data and some of the new techniques that we have through machine learning, neural networks, and all of the other tooling that came with more computing power and more data. That is really changing how a lot of the financial markets are working. And for us, it means that machine learning is core to digitization in a very broad sense. It means different things in different contexts. And I think that is one of the challenges here, and that these are clearly big underlying macro trends, but they mean very different things in different contexts. And sometimes it's a bit easy to fall in the trap of AI as a buzzword solution to lots of different things. But to give you concrete examples of how this is core to our journey and to the digitization of what we do and financial markets more broadly, natural language processing is something that is changing how we collect data. So as you know, and I'm always surprised with how people that are growing up with this are much less aware of how significant this is. But as you know, we used to get data delivered in very clear, neat boxes, files. You went to a portal, you downloaded something, or somebody put a file on your server somewhere, and you did your research and your analysis on that. And it was that closed box of data. We are now increasingly consuming unstructured data, so data that doesn't fit in a neat box. Could be text somewhere, could be audio somewhere, could be a piece of weather data. We're consuming that, we're translating it, we're capturing it in new ways, and we're connecting it to data in new ways as well. So the idea of a neat Excel type spreadsheet is increasingly irrelevant, and that data gets connected through graphs, through very flexible ways, for example. And that is core to what we do. Very concrete example in the index world, we have a natural language processing thematics engine. And what that does, it tries to find companies that do something particular, a theme. So traditionally, the way of categorizing companies is in very rigid structures. You look at most of their revenues derive from this activity. Therefore, it is probably a telecom company. Therefore, it is classified as a telecom company for now until the next revision. What we're doing now is we have these unstructured data engines that reads through all kinds of outputs from a company, whether that's CEO speeches or things like that, pick up on what their focus areas are, and group companies, for example, based on certain green activities. And we can do that every month, we can do that every quarter. So we can create groups of companies, portfolios that are changing depending on how the focus of the company changes over time. And that's only possible because of machine learning. And it's just one example of how things are changing, but there are many of those.
I just push that a little bit further and put your future seek visioning glasses on. How do you see the business expanding in the future? How do you see, we're talking machine learning and NLP, and so where do you see things going in the future for you guys and in general for this type of business?
Yes, so there are so many big macro trends, big forces at play that are changing our business, my index business, broader London Stock Exchange Group, financial service provider business, financial market as a whole. But some of the big trends that I think about most are, one is well underway. It's well known. It continues. It's the shift from active investing to passive investing. So this is very much embodied by ETFs and all of the assets under management that those have gathered. And it basically means that the focus on how people allocate to securities, to investments, is increasingly rules-driven. It's completely transparent. It's an index format. It is not by stock picking individual names or choosing individual bonds or looking at certain securitized products in a lot of detail in terms of how their covenants work. It's rules-based baskets of investment instruments, and the reason for that is that there's a very clear understanding that has come to a lot of the research that people in academia have done, in industry have done. Well, I'll give you one example. I recently met Hank Bessenbinder, who has done a lot of research on how the distribution of returns across stock markets is distributed. Mm-hmm. And his observation is that there's a very small percentage of stocks that actually outperform. Most of the performance in stock markets is driven by the winners, the few winners. And the conclusions that you can draw from that are that, one, if you're going to be active, if you're going to be somebody that picks stocks individually, you need to have very high conviction, and you need to have concentrated portfolios. If you're not that person, if you don't have that conviction, if you don't have that skill, you're best off with big, broad basket indices. And that's a trend that we've seen playing out, the shift from active to passive, and the flows into passive is very significant in equity markets. It's been going on for a long time now. It's only just really starting in fixed income, but that's driving a lot of what's changing in markets. For my business, that we benefit very much from that. We provide the indices that are linked to passive investments. We provide the tooling and the data that people use to set up those vehicles and to monitor them, etc. But more broadly as well for the whole industry, and that there's a lot of fee pressure in the asset management industry, for example, because it's much cheaper to do passive investing. It's much easier to have clear rules-based indices and track those with technology. than it is to have individuals go through long lists of names. So that's a big trend. The other big trend is technology and data, and how much easier it makes that for people to get things done in financial markets. So information used to be a source of distinction, alpha. That's increasingly less the case. More and more people have the same data. Data is exploding. There's much more of it. Technology makes it possible to process the data, to quickly action on the data, to deliver it to end users, to put the power in the hand of decision makers very directly. And I think it was Amin who gave the remarks that we just listened to. He spoke about retail investing. That's a good example of that. So that's a big trend, that commoditization and democratization of technology and data that lowers the barriers to entry for financial market players. And then we have a trend of a lot of wealth increasingly being very sophisticated. Retail investors, institutional asset owners, and looking for custom ways of getting their money into the markets. And that leads to a trend of what in the US is called direct indexing, where you build very micro custom solutions for people, but through technology and through data and through passive solutions. So a couple of really big trends that are going to transform markets for years to come. Our opportunity in that is very much fixed income. Fixed income markets are much more complex than equity markets, and we are only starting to see them become as liquid, as transparent as equity markets, and that will change how people access them. So more indices, more data, more analytics there as well. Sustainable investing is transforming financial markets, and that it's becoming core to decision making everywhere. And that's a big trend for us and something that we're very focused on. So this is all about making the data available, facilitating standard setting, etc. And then that customization trend that I was speaking about, for us, that means building platforms, building access tools, etc. So very big picture, increased digitization, really being driven by these big underlying macro forces.
Great. Now, do you see any real differences between, say, the U.S. and the European markets, or are they pretty much the same? Just securities or things may be slightly different, but there are any clear distinctions between both?
There's a number of dimensions in which they're quite different. So to start with one, we work a lot with asset owners, institutional asset owners. So pension funds, insurance companies, sovereign wealth funds. So all of the end beneficiaries of financial market investments, not the people managing the money on their behalf, but the people that actually own the assets. And that tend to be very different in Europe and the US in terms of how they operate, how they think about the world. You have very sophisticated, very large asset owners on both sides, but they are different, and they focus differently on questions of sustainable investing. They focus differently on how much hedge fund, private equity exposure they want in portfolios, etc. So big differences there. Europe is more fractured and less homogeneous, as you know, in the way the different markets come together. It works very well at the end of the day, but it's different regulators, different systems, different exchanges. I think the place where I see the largest difference, and going back to one of the big points that we see happening in markets, is sustainable investing. And that's a place where Europe is ahead of the US, but global markets in general, in terms of how it thinks about standard setting, regulation, how you put the framework in place that will make sustainable investing meaningful, in the sense that we all think about definitions in the same way, we think about impact in the same way, and we hold people accountable in the same way. So big differences, but equally sophisticated, and a lot of people that work across the two, and that there's no issue in doing that.
So let's kind of shift more macro. You talked a bit about sustainability, but so at last couple of weeks, Glasgow, Scotland, COP26, where everyone was there. If you're a leader, corporate leader, national leaders, just to give your sense of the meetings, what was encouraging, what that came out of it, what was sort of disappointing, and are there, and again, the same question about differences across countries. One you hit already between the U.S. and in Europe, but so coming out of that, what's your take on success, failures, or encouraging signs, not so encouraging signs?
Yeah, so you put it very well, Rohan. Everyone was there. Even I was invited. So we had a very big event in Glasgow. My takeaways from COP26. So it's easy to be skeptical, and it's easy to read skeptical headlines, and it's easy to think, okay, well, we've all heard about the 400 or 500 private planes that flew in and the carbon footprint that comes with that. We've all heard about some of the progress that has not been made, the agreements that not quite have come out as hoped for. So it's easy to be skeptical, but I'm actually very optimistic in terms of what has been accomplished in that. I think the focus on climate change that event signified, and that I think we'll have as a world and a global economy going forward, it has really very significantly increased. And I think that all of the noise around it, you need that noise for people to get engaged enough and focused enough to really drive the change that we need. So my overall perception is that yes, it's not perfect. We're not there with a lot of different issues that need to be resolved, but progress is being made, and there is focus and there is urgency that is necessary. I would say that and I have two small daughters, and the more I think about their future, the more concerned I get about climate, because you can think this will last your time, right? But it will last their time as well. What I am concerned about is that we have commitments, we have net zero, we have what are called nationally determined contributions, which are plans for achieving net zero. But none of it puts us on a path to 1.5 degrees warming, which scientific consensus thinks is the safe threshold. Best case scenario, we're still over 2 degrees warming, even if everything gets executed like governments are currently planning for. So we're headed in the right direction, but a lot more needs to get done. And that will require focus from financial markets, from governments, from regulators, from stakeholders, from individuals. And I'm personally glad that we have a part to play there. I think financial markets are an important piece of the puzzle at meeting climate objectives.
Mm-hmm. As an index provider, I mean, elaborate on that a little bit further in terms of your role in climate change. What role do you think that is from an index provider? What can you do, or your group do?
Yeah, that's a great question. So what needs to happen to change the economies, to get close to drive decarbonization and to get close to net zero? There need to be huge changes in how capital is allocated and how capital flows. There need to be much more transparency in terms of how different companies do different things, how it's measured, how the impact is measured, how we see their activities. So there's a big question of data, transparency, regulatory standards, industry standards. And then there's that question of how do you get the capital to flow to the parts of the economy that are going to drive the decarbonization. And indices have a role to play in that latter part. So I run FTSE Russell. We have $18 trillion or so benchmarked to our indices. So that's $18 trillion that are one way or another will follow where the indices go. And if we work with our stakeholders, so the asset managers, the asset owners, regulators, etc., all of the people that have a stake in how indices develop, if we work with them to point the indices at climate objectives, then they will play a big role in facilitating that capital into decarbonization. And we see early signs of that. We have launched indices that are aligned with the Paris goals, the Paris Agreement goals. So they look at existing portfolios, for example, of equities, and they look at how do you need to select and reweigh the stocks in there, so that the stocks in there are companies that align with the climate objectives. And people are starting to invest there. We see that trend from plain vanilla passive investing to climate investing.
Now, just the last things here. One of the mechanisms that regulators and investors use are the ESG ratings, right? And so there's discussion about regulating ESG ratings, and so if they're regulated, how can this hamper, or what's the impact that will have on your business?
Yeah, I think as a business person, there's always a little bit of a knee-jerk mental reaction that regulation is probably going to mean constraints. It's going to make business more difficult. Perhaps rightly so, but it's going to make business more difficult. I think in the case of ESG in particular, what we're dealing with is a big challenge in that ESG is a very fragmented concept. So there is no uniform layer of truth. There is no definition on the data that we use to measure ESG. There's a lot of data available, but different houses like our own have different ways of collecting it, have different data points that they collect, have different ways of interpreting data points. And then they have different ways of deriving information from that data, really putting the ESG scores together and the modeling that goes into saying, well, this company is a very positive ESG company. That one is a less positive ESG company. So there is no common understanding, no transparency, level playing field. And so we welcome regulation in ESG in that we need standards that apply across the economy, preferably across regions as well. So the more the US is aligned with Europe, with Asia, the easier it is for capital markets and financial markets to make the same type of decisions when it comes to ESG and interpret things in the same way. So we need common standards. We need common data. And that will drive also how so that doesn't mean that everybody will use that data and scores in the same way. That there will be a need for different solutions for different people, but the solution has to be based on a common truth and with a transparent methodology, so people can evaluate very clearly whether this is fit for purpose for their circumstances. And I think that's where we're at. We're going into a maturing of ESG investing, really. Okay.
If we have time for one last question here, I wanted to. The other big topic from an investor standpoint are digital assets. You guys, what are some types of new products that you expect to introduce related to digital assets, knowing that that's one of the trends that are out there?
Yeah, that's a fascinating topic. I find it personally fascinating. I'm not an expert. I think there's probably many people listening to this that know much more about this than I do, because it's hugely complicated. And it is immature in the sense that it's developing very quickly, and it's not quite clear where it's going to land. In a parallel with ESG, sustainable investing as well, there is a need there for more common standards. I'm sure regulators are starting to pay more attention and starting to think about providing frameworks around digital assets in a way that doesn't exist currently yet. But the clear opportunities that we see and some of the products that we're developing are providing transparency on digital assets. So Unlike a stock price, which comes from an exchange, you get a data feed and you know exactly what was traded, where, what, for how much, timestamp, liquidity, bid offers, you have all that data. The price of most digital assets is not transparent, it's not uniquely determined, it depends on the exchange. There are lots of different exchanges. Many of them are not regulated to do the same standard as equity markets are, for example. So we see our role there as helping collect that data, provide transparency, again, the clear definitions, and we publish indices that show you the price of Bitcoin, of Ethereum, of Cardano, of all of those different types of assets. So people have an anchoring point that doesn't depend on the exchange that they're looking at. But there's much more to come there. It's a fascinating field.
Great. Well, Arne, thank you very much for this discussion. It was very informative. And it was great to pick your brain on some of these things and with your global perspective and your insights on Glasgow. You were actually there. And also it's good to know Hank Bessenbinder, who's, I guess, a friend of both of ours, Hank's and his insights.